I say, when it looks like this, we call it an engulfing pattern. This look, I don't want to talk about patterns at all. You must learn at every moment that if your previous view failed, you should look for the next scenarios. If you move in sync with the market, you're no longer looking for predictions, nor are you looking for where the price will reach tomorrow. You'll know which event is more likely to happen so you can ride the market with your risk in that direction. Anyone who comes along starts drawing lines saying, here is resistance, drawing lines saying, here is support, and buy here, sell here. This indicator goes into oversold. I should buy. It comes into overbought. Guys, such a thing doesn't exist at all. I'm saying you should throw all of those away. It was all a lie. Moon is saying some things. He says everything you've learned so far was a lie. So what is the right way? So where decision making supports you, only then do you make a profit. Be sure that I shouldn't be too much into this, into getting a trigger and such pattern forming and these things. How do I go and hit that shadow there now? How in our DB channel, where we put 10 setups, 7 of them come and activate a sniper shadow. We'll learn it in this course. If I have a strategy in the crypto world for trading or even for my own investment purposes, and this particular strategy gives me stress, even if this strategy can actually be practical for me and make a profit in the long run, I still cannot use it. Anyone who is in my place and you who are watching this video also cannot use it and cannot reach that profit. I'm saying this to get to this point. Sir, the technical analysis that they have been teaching us up until today and the various price action styles for which we were charged for training were really just a series of repetitive patterns that we simply called by different names. In essence, these so-called new styles were created by just putting a new name on the same patterns so that we would be encouraged and think that if we didn't get results from our strategy, maybe this new approach would finally work for us. The issue was about that previous strategy. The issue was about our previous analytical style that was flawed and is now outdated. Guys, does anything become outdated in the world of mathematics? For example, is it possible if something called an integral was created? I say, okay, now there's an integral, so addition and subtraction are now outdated. Addition no longer works. Subtraction has lost its rationality and logic. No, such a thing really does not happen. In fact, from the very beginning, what has been taught to us, as well as what is available in the market for us to learn, is actually quite redundant and has been given too much focus. So overall, the emphasis on these things has been excessive. Everything you need to know about technical analysis. I'm starting a free course, and this video is the very beginning of that course, where I'll be explaining everything to you in detail. You should know that in the crypto market, especially if you're looking to invest or trade, technical analysis, or what is often called price action, only makes up about 10% of your overall strategy and trading style. In other words, while technical analysis is important, it is just a small part of a much larger approach to trading and investing. You just need to grasp some of the essential basics and the general concepts of technical analysis. Combined with the other valuable content that I'm sharing on my channel, as well as on Instagram, these elements together can really help you build a solid and effective strategy for your trading journey. So I need to understand some basic and fundamental aspects of technical analysis. When I say basic and fundamental, it doesn't mean you should think, okay, I already know support and resistance, so this course isn't for me. Or, I'm already familiar with candlestick patterns, so I don't need this course. I want to tell you that your current understanding of support and resistance might actually be wrong, and I want to completely shift that perspective. Let's change our mindset towards the market and transform our approach to trading. We should stop chasing past patterns altogether and adopt a completely fresh perspective on our technical analysis. The approach in this course is not going to be strictly based on classic technical analysis. In fact, we're going to set those classic patterns aside completely. We'll only be using indicators and oscillators in just a couple of specific instances. We're not being dogmatic about it, though. It's not as if we're saying, okay, you should never use indicators because they're completely useless, or that price action is worthless and we must only rely on indicators, oscillators, and classic technicals to succeed. I'm going to teach you exactly what you need to know about technical analysis. And one more thing. If you want to see results in any financial market, and develop a powerful strategy, your priority must be ensuring that your strategy doesn't become a source of stress, anxiety, or mental strain. You see, some people are just looking to say, okay, technical analysis is only 10% of the equation. Moin is right, and we agree, they're actually creating content for you right now. But they say the remaining 90% is all about emotional control. That remaining 90% is self-control, so that we can be a successful trader. Guys, it's not even that, at least not in the crypto market. Because if you have a strategy that only gives you an entry point after a pattern forms, like if you want the candle to engulf the previous one before entering, the difference you get relative to your entry point will take away your confidence in that trade. If you know at what point it's best to enter and exit a trade, it means you have exactly what you need in terms of technicals and price action. And if you've followed our work, you'll notice that we get that remaining 90% of self-control from the strength of our strategy and the tools we use. This self-control is what truly sets successful traders apart. What's important for you in technical analysis and what you'll learn in this course is support, resistance, and candlestick patterns, but not the way they usually teach you. Not like I'm going to say when it looks like this, we call it an engulfing pattern, or when it looks like I don't want to talk about patterns at all. You should see every single candle forming on the chart, and they should give you a feeling. They should tell you, I'm confirming your previous view and analysis, or I'm failing it, and you must learn to look for the next scenarios if your previous view fails. If you move in sync with the market, you're no longer just looking for predictions or trying to guess where the price will be tomorrow, and you'll know with greater clarity which event is more likely, so you can confidently ride the market in that direction. Okay? So, candlestick patterns, not the way they were talked about before, not like I want to talk about Marubozu or, I don't know, Asghar and Hassan. Support, resistance, and volume are some of the most important things that will help you in your trades. Money flow, and finally, momentum. I'll explain these to you. We're not going to think, okay, so Moin Ghaffari says I'm going to teach you the basics. So it's just the same things that like anyone who comes along says, drawing lines and saying, this is resistance, this is support, buy here, sell here. This indicator goes into oversold. I should buy, it goes into overbought. Guys, such a thing doesn't exist at all. I'm telling you to just throw all of that away. It was all a lie. Okay. It was a lie so you'd spend money to learn new styles and spend money to make the markets wealthy even richer. It's the retail investors' money that lines the pockets of the major investors in the market. The retail investor who does not have a team to analyze opportunities for them, no group to help distribute their risk, and often does not even realize that without proper risk management, which really requires a team, not just one person, is at a clear disadvantage. You can't get results in the market, and you're ultimately the loser of this game. And only the single way we can profit from a financial market, in my personal opinion, is to be able to understand what plan the big traders in the market have laid out for us. I want your perspective on the market to become like this. In the first session, we're actually going to learn exactly this. Look, what does the market even mean? And when I'm trading in a financial market called the digital currency market, what should my perspective on that chart be like? Should I be looking to draw lines? Or what should I be searching for? Mine is saying some things. He says everything you've learned so far was a lie. So what's the right way? Let's go see together. First, I want to talk about the reason for price changes. Why does the price of something even change? Before I tell you what the reason for price change is, I want you to think about what price actually is until I finish talking. What do you think we call price? When we say, for example, the price of this gold bracelet is this much, what does it mean? When we say how much the price of this, say, computer is, what are we actually saying? What determines the price of this? Okay, the first thing that comes to your mind is supply and demand, which I'm telling you right now to dismiss. It's wrong. Now let's go to the reason for price change until we get to what price actually is. First, we want to say the signals that If I say signal, it doesn't mean a signal channel told you something. Signal means a sign. I'm getting signs for buying, I'm getting signs for selling. Your view of a signal channel should be the same. It's giving you a sign. If you trust the person and think they're giving you a correct signal, there's a chance what the signal says will happen. They're giving you a sign for you to follow up on. Now you should also check your chart yourself and know for yourself how much volume you should enter with. It's not supposed to be all that. I've seen some people give leverage, for example, in their channels. We ourselves occasionally announce leverage in our channel too. But it's actually a fake practice. Why do I announce leverage? So that some people don't go and use, say, leverage of 100 at all, even if we do announce it. But the point is, it doesn't matter what the leverage is. My trade size is what matters. What's the difference between $10 with 100 leverage or $10 with 10 leverage versus $5 with 20 leverage? I need to learn this difference. Now, if there's an opportunity, I'll talk to you about money management and risk management and how we should determine our entry volume for each trade. Let's see if this course gets a good reception or not, if you're interested in continuing in this field, and we'll get to those as well. It says, look, signals based on indicators and price movement are themselves the effect of price change. How complex this sentence is, it seems difficult. It's not that hard. It says, look, indicators and oscillators apply a mathematical formula to the price chart, the price that's moving. The price enters a mathematical pattern and gives an output that creates the RSI for me. Price changes over a period of time are entered into a formula, then they are added together and finally divided, which creates the moving average for me. This method helps smooth out price movements. Now I see the moving average on my chart, right? So this moving average originates from a formula where the variable itself is the price. If the price goes up, the moving average goes up too, right? So if we are able to identify the underlying cause of a price change, and if I am going to work with indicators and oscillators, then what I am really doing is looking for the effect that the price change has produced. The price has already changed by the time this gives me a result. But I really need to carefully look for and clearly identify the underlying cause of any price change so I can better understand potential moves before they actually happen. That means I'm not supposed to just see an engulfing pattern and then immediately enter my buy trade. I'm not supposed to wait to see this candle close at the bottom, confirm, and then enter my trade. Okay. When I enter a trade at a better level, I'm not looking for confirmation, not for excessive confirmations. Even in technical analysis, I don't look for a confirmation candle. I don't look for a confirmation pattern. I have a smaller stop loss and a powerful strategy. I can put into practice the things I learned from money management and emotional control, whether I am applying these lessons myself or sharing what I know in different places, like when I teach or talk about these topics to help others understand and use them in their own lives. If it's not this, then all that nonsense like, yeah, believe in yourself, don't be greedy, set aside fear and greed in the market. So it is just a sentence. Okay. I get on the price movement sooner than others, which again helps me be more in control of my trade. It predicts price continuation or pauses. Meaning I can understand that analysis is only meant to give me this. So I know, look, this trend that's happening is going to pause at a certain level. When its trend will change and drop, and when it'll pause and continue its movement. Or whether the price will pause at a certain level for a while, or perhaps move upwards and have that upward movement continue for some time. The fact that you see me explaining so much in detail might not be particularly interesting or exciting for many of you, but I sincerely apologize for that because I have this personal obsession, this tendency where I really want to talk about things thoroughly, in depth, and explain every single sentence, every detail, every aspect related to it so that nothing is left unclear or misunderstood. I just want to make sure everything is as clear as possible for everyone listening. Even though in the marketing world, social media, Instagram, YouTube, or any platform, users like to get to the point very quickly and concisely. But well, you'll never actually get results that way. If you're looking for a 1-minute reel, for example, on Instagram for me to teach you what technical analysis is, well, nobody can do that. And sometimes I see content where someone says something and I think, okay, what happened? What did I actually learn just now? Like that phrase, for instance, fear and greed are very bad guys. That's it. The guy got SC scared once and his trade blew up. Now, I'll show you this in more engaging ways, or for example, I'll bring 2 or 3 of my friends into a video and make a video for you showing it's like this, trying to teach you that same sentence more attractively. What is price? How does price move, and what is the market? These are the steps that are going to teach me what the cause of price change is. I told you to think about what we actually call price. And surely many of you thought that, well, price is just the value of an asset. While these two are actually completely different, price is the result of the buying and selling action of 2 traders. Meaning, if I say the price of this is 10,000 tomans, someone must have just bought and sold it for 10,000 tomans. A transaction must have taken place. Now, the value of this might be 20,000 tomans, but its price is 10,000 tomans. The value of a pride right now might be 40 million tomans, but its price is 400 million tomans. Okay? So value and price are completely different things, and price is the result of the action of 2 traders. Remember this sentence. If you internalize these sentences, I promise you'll be a great analyst by the end of this course. Price changes usually happen as a result of the balance between supply and demand, right? Supply and demand determine the price, but that's just a cliche that anyone can say. However, there are drivers for supply and demand. How do I know if supply is high or demand is high? How do I know if supply or demand will be high in a range? The drivers of supply and demand are the ratio of buyers to sellers, their numbers. Are there more buyers or sellers? But does a higher number of buyers always mean higher demand? No. So the volume is also important. How much does each buyer want to buy, and how much does the seller want to sell? Right? Besides that, the obligation of the buyer and seller is important. The necessity for the buyer and seller is important. So I shouldn't just look for a level where buyers will simply place orders. A demand level for me is one where buyers have a necessity to buy. Who has a necessity to buy in the market, guys? Someone who has set a stop loss for their sell trade. They have a necessity to buy to exit their sell trade. When I open a short trade at this level, I put a stop loss here. If the price goes up against my opinion and analysis and hits the stop loss, I must buy. That is what necessity means. So I should look on the chart for where buyers and sellers have a necessity to buy or sell, not just where their numbers might increase or decrease. Although one of the factors is the number and volume of trades. Hope and despair among buyers or sellers. Where does a buyer lose hope? Where does a seller lose hope? I remember posting an Ethereum analysis saying it could break this support level based on its movement pattern. Where do I get this from? No one taught me that if lower highs were above a flat bottom, that's not how I'm supposed to learn the market. Because I see the buyer's hope level here, buying but failing each time to hit the previous high where they said their take profit. Look, the price peaked here, came down and reached a floor. It didn't reach the peak to hit the take profit and returned here again, twice. The last time I make my trade risk-free, where I make my trade risk-free and put the stop loss at my entry point. If the price hits my entry point next time, what is the stop loss for my buy trade, guys? It's a sell, and this level can break. Okay, so now I have a shadow below this area, right? What many call liquidity collection, or this level is about to break, you know. So I won't choose this level for a buy trade anymore. Let's move forward so you can get a clearer picture. For now, we're just discussing the theory together. Let's see, let's get familiar with some of the terms to have a common understanding of the chart and the analysis. When demand is higher than supply, demand higher than supply, we have more buyers than sellers. The urgency is greater for the buyers, right? And the sellers are more discouraged. Buyers are still hopeful for a price increase. Buyers are willing to pay a higher price to buy, so the price goes up. It's very simple, right? The buyer is hopeful. Even if the Bitcoin price hits 75,000 now, the buyer is still hopeful. It's 66,000 today. If it goes and say, breaks the previous peak, the recent peak that was formed, there are still buyers because many are still hopeful for a price increase. How high will the price go? Until there are no more buyers, there are more buyers, so the price is going up. Why? Because they're willing to pay a higher price, because they hope it will keep going much higher for a while. How much will they pay? How high will this price go? Either there are no more buyers at this level, or supply happens to an extent that it completely covers the demand. So what happened? There are two sides to this. Either the buyers decrease. Look, I have a scale. If there are more buyers, the price goes up. If there are more sellers, the price drops. Okay, so this scale is the sellers and this is the buyers. How high will the buyers push the price? Until either these values start to decrease, or those other values begin to increase, or perhaps in some way, both of these factors eventually balance each other out, the overall situation will remain the same for now. Meaning either there are no more buyers, or sellers increase so much, meaning the price goes so high that for someone like me, who bought Bitcoin at say $30,000, it's worth selling at $80,000. So the price goes up until it's profitable for buyers at lower prices to take profit at some point. So the trend changes, or even a correction happens when either previous buyers want to take profit, or new sellers enter the market, or there are no more buyers left to maintain this balance. When supply exceeds demand, conversely, I'm willing to sell at lower prices. Look, there are no buyers, and I need the cash. I want to sell a car, but nobody's buying. I have to offer it 30 below the price so they'll buy it. So the price goes down. When I sell 30 below the price, what does that mean? A transaction has taken place between two people. So when this trade happens 30 lower, the price is considered 30 million cheaper until the next trade. Every single transaction that occurs determines the real-time market price. Now, how far does the price drop when supply is higher? Until either there are no more sellers or enough new buyers are drawn to the market to cover all this selling pressure, to cover all this supply. Meaning the price drops so much that it becomes very profitable, right? In fact, price change is the result of an imbalance in supply and demand, which itself stems from an imbalance in the sense of urgency for buying, the urgency of the buyer and seller. So among these three things I mentioned, hope and despair, the number and volume of buyers and sellers, and the urgency between them, what matters to us is when a trader feels a sense of urgency and desperation. They must exit the trade. They must enter into a trade. That becomes the level where I'm looking to execute my own trade. Upward pressure. It's a term, I'll memorize it from now on. Upward pressure is the sum of all demand. Downward pressure is the sum of all supply. Order flow is the net result of upward and downward pressure. For example, if we say, look, the order flow is negative, as we might have mentioned in our course, it means downward pressure is greater than upward. If order flow is positive, upward pressure is greater than downward. Total demand is greater than supply. Now we've come to the true nature of the market and the perspective we should have toward it as a trader. The true nature of the market is the decision of the traders. That's it. What determines the price? Aren't we looking for the reason behind price changes? You and I, as traders, determine the price. Our decision now determines what the price will be. The price at which we are willing to be buyers, the price at which we are willing to be sellers. And if you can figure out where other buyers and sellers, and the wealthier ones with larger assets in the market, are going to buy and sell, you'll be the winner of this game. You'll get a share alongside those market giants. We said that the market, look, is really about price change. Wherever there is any kind of price change happening, a market exists. Oh boy. Traders' decisions create the order flow, right? Order flow was the net result of supply and demand, right? The result of these two created the order flow. Who causes supply and demand to happen? It happens because of the traders, of course. So the effect of order flow is that very price change. Right? So price change in the market ultimately comes down to the actions and decisions made by traders. The market itself is, in essence, a constant process of price change. Price change arises from shifts in order flow, as well as from the overall net result of both buying and selling pressure. And who is responsible for creating this net result of order flow? It is, of course, the traders themselves through their ongoing choices and actions. Who generates supply and demand? Traders and the decisions they make to buy or sell at a certain price level. So from now on, I see the market as the traders' decisions. I don't say the market is a place where some people buy and sell. I don't say the market is just a place where a price changes, like we used a few minutes ago, or a place where some supply and demand exists. I would say that the market is essentially something that is created by the decisions made by a group of traders. Let's go through an example for you. But first, let me tell you a few other points. What does profit mean in their minds? Buying at lower prices and selling at higher prices, or vice versa. It seems very simple. But why does no one get results in this market? Why do only 2 out of 100 people get results in this market? Because making a profit isn't as easy as its definition makes it seem. You must enter a trade where, if you don't lose your money and see the kind of nonsense they're feeding you, you won't understand what I'm teaching you. You won't appreciate it. So you only start making a profit when the trader's decisions actually support yours. Rest assured, it's not about, so I shouldn't be looking for triggers or waiting for specific patterns to form and all that. Now, how do I go about hitting that shadow over there? How did you see in our channel that out of 10 setups we post, 7 of them trigger a sniper shadow? We'll learn all about it in this course. The overall flow of orders needs to support your decision. To buy or sell at points where most traders will follow our lead and push us into profit, we need to identify the trader's decision-making zones. Our terminology for everything is different. We're going to completely scrap terms like supply and demand zones, RTM, and all that other nonsense. Let's head over to the chart. I've pulled up the weekly Bitcoin chart here, as it's something many of you are quite familiar with. I want to talk about a pullback. In this course, we refer to all price corrections as pullbacks. A specific resistance level doesn't necessarily have to be broken for us to call it a pullback. Any price correction, we call it a price correction in an uptrend or a downtrend. Any correction that occurs, we call it a pullback. So whether I call it a correction or a pullback, it makes no difference. I had an uptrend here, and now you might be wondering, on what basis am I actually calling it bullish? Well, I know the reason why, and as we continue, you'll learn it too, step by step, as we go along together. Now, this uptrend, let me take a much closer, more detailed look at it for you. Let's really examine what is happening here, so you can understand the reasoning behind calling it bullish. I'm drawing its highs and lows. To draw it correctly, there's another correction here, and this high ends up forming the highest high. If this low breaks the low that led to the highest high, then from that point on, I consider the trend to be bearish. Many people use this tool on my chart, the 51 moving average. Right now, it's actually the 51-week moving average on this chart. This means it calculates the average over the past 51 weeks, which helps smooth out the data and highlight longer-term trends. Many people look at this and say, okay, look how I reacted to the moving average every time. See, I hit the moving average here and moved up, the chart didn't confirm below it, and then the price approaches the moving average again and moves. In many places, it acts as a support and resistance level. You can see that I use the 51 moving average on my charts, but I approach it with a different perspective. Why do I say a different perspective? Because where do I see the trend turning bearish here? In my view, the trend turns bearish when the low leading to the last high breaks. You'll learn all about this in detail later on. When I see something like this, I look for its pullback. I expect to see the next leg of the move. Now, from this point forward, where can I say the trend has changed? I have a high here, but it didn't create a lower low. The last high that made a lower low, I'll press Alt-H, is this one. Until this breaks, the trend won't be bullish for me, Moin. Got it? But, my dear friend who uses moving averages for your trading strategy, didn't you actually get a confirmation signal right above your moving average here? Shouldn't it pull back here and then head higher? So why is it crashing? Because you've ignored the definition of a trend. In a downtrend, you're going long against the trend just because your moving average broke. Are you at war with the trend? You're missing something far more important, because technical lies have taken hold of you. Now, I'll tell you how you should look at this moving average. So why is it even on my chart, Moen's chart? I say during a pullback in the market, let's look at it this way for a moment. There are some people who choose to enter short positions during this kind of pullback, taking advantage of the downward movement. Right? I had a support level right here. Why? It hit this, then it came back for a pullback here. People went short during this pullback, obviously. I have a support level right here. See it? It's the bottom of the previous candle's shadow. I'm not even considering the moving average for now. I'll bring up the mindset of the traders who went short here, for whatever reason. So more people went short, which is why the price dropped. What do I expect from them? I expect them to take some profits at the previous price low. So at the very least, I expect a pause in the price. I'm not saying this is support just because the shadow's low is here. I'm saying whoever went short here will definitely look to take profit at the previous low. Now, this profit taking either reverses the trend or causes a pause before it continues. Now, this low breaks. Right? So let me explain how I analyze the break of this low in a bit more detail. What I mean is, I see the sellers are really making a strong and determined effort to break through what is actually a significant support level in the market. Even though for a moment the price seems to pause or hesitate, the sellers eventually tip the scales quite heavily towards supply. As a result, this important support level ultimately breaks. And that's the process I observe here. Got it? How far down will the price go again? To another support zone that I had right here. See? I have a support zone right here. Right? Profit taking occurs. This profit taking causes the price to move upward. But why does a pullback even happen? Why is it that when the price returns to this area, the area that led to the break of the previous low, it tends to move down again? Why does this pullback happen? Because those who didn't manage to sell at this peak or during the previous correction are now looking for an opportunity. They're waiting for a chance to take advantage of the next correction. Okay. So, whenever we look at a pullback, this is how I view it. Look, a group of buyers bought at a support level and pushed the price up to here. Now, why does the price have a correction when it reaches here, which is again a resistance zone? Why does this candle turn red? Because the primary reason is profit taking by people who bought in stages here. When the price hits this point, those who bought down here will definitely take some profit. Now, when the price returns to this level, which is again in this peak area, why does it move upward from here again? Because there are people who see a strong uptrend starting, and having missed the chance to buy at the bottom, they're looking for an entry at the next support levels. These actions cause the price to increase again. So from now on, this is how we'll look at pullbacks. We analyze the trader's decisions in everything. I just gave you the pullback as an example. Now here I have a complex pullback that brings the price above the moving average. If I pay even closer attention to the trend definition, I'd actually prefer to enter a trade right here during this particular pullback. Entering a trade anywhere on this candle is attractive to me. Why? Because after I enter this trade, this particular candle then comes along and really supports my decision. In fact, it gives me even more confidence in my choice. I'm not going to wait around to see this pattern or this model. Whatever the hell you want to call it, wait for this specific pattern and then enter the trade. If I enter the trade here, guys, on this candle after getting this confirmation, my stop loss for the trade ends up being 17%. Whereas where is my first take profit, guys? Like everyone else, I'll set a take profit for myself at the next support level. That's 15%. Meaning my take profit has a 1-to-1 ratio with my stop loss. This way of trading, you just can't apply trading psychology to it at all. You can't control fear and greed in it at all. What are we looking for? Well, guys, I hope you found the first part of this course useful. I went off on a few tangents in this session, talking about things outside of our technical topic. I hope you'll kindly excuse these diversions. I wanted to give you comprehensive data, but I ended up talking too much. If you found this video helpful, please support us with your likes and valuable comments to keep me motivated to create the next videos in this course. Until next time, goodbye. May your losses be small and your success great.